Scalping trading means taking small, quick profits by exploiting short-term price movements, with traders entering and exiting positions rapidly to minimize market exposure and focus on high frequency rather than large gains per trade, often holding positions for only seconds or minutes and reacting immediately to adverse movements without carrying a fixed market view. One of the most famous scalpers, Paul Rotter, reportedly earned $65 to $78 million annually for a decade by trading highly liquid futures contracts on Eurex, starting his career in a Munich trading room before moving to Daiwa Securities in Frankfurt, where he became profitable quickly and earning the nickname the Flipper, for a strategy that involved placing large visible orders to influence other traders, then canceling and reversing them to trap participants and profit from the resulting price moves. His approach relied heavily on reading market psychology rather than technical patterns, constantly assessing what other traders were doing and adapting in real time, guided by his belief that traders should have no strong opinions to avoid holding losing positions too long, and describing his method as a form of short-term market making, using simultaneous buy and sell orders based on order book activity. At his peak, Rotter traded up to 180,000 contracts daily and averaged around 3 million lots per month, dominating trading volume for years, while emphasizing that his real edge came not just from strategy, but from strict discipline, strong money management, and the ability to continuously adapt to changing market conditions. To go deeper, scalping at the level practiced by Paul Rotter is less about predicting price and more about controlling risk and exploiting microstructure inefficiencies. Things like bid-ask spreads, order book imbalance, liquidity gaps, and the speed at which orders appear and disappear. Elite scalpers operate almost like liquidity providers, constantly placing and canceling limit orders to feel where real buying or selling pressure exists, while using tools such as level 2 data, time and sales, and ultra-fast execution to gain a timing edge measured in milliseconds, not minutes. Rotter's so-called flipper behavior also sits in a gray area of modern regulation because rapidly placing and canceling large orders to influence other participants resembles what is now closely monitored as spoofing in many markets, meaning that while the underlying principle of reading and reacting to crowd behavior is still valid, the exact tactics require strict compliance awareness today. Beyond execution, professional scalping demands extremely low transaction costs, high leverage with tight risk controls, and a mental framework built on probability rather than certainty, accepting that most trades are small wins or scratches while avoiding large losses at all costs, since one undisciplined trade can wipe out hundreds of successful scalps, which is why top traders focus obsessively on consistency, emotional neutrality, and maintaining a repeatable process rather than chasing any single trade outcome. At the deepest level, elite scalping becomes a game of statistical edge and execution precision, where traders like Paul Rotter think in terms of expected value per trade rather than individual outcomes, constantly asking whether a setup offers a tiny but repeatable advantage that can be compounded thousands of times. This involves breaking the market down into micro-events, such as how price reacts when a large order gets partially filled, how quickly liquidity replenishes after being hit, or how aggressive buyers behave near key levels, and then building an internal playbook of patterns that are not visible on traditional charts, but emerge in the order flow itself. Execution becomes almost mechanical, with predefined entry, exit, and position sizing rules, while risk is managed dynamically by cutting trades the moment the underlying order flow shifts, often within seconds. Over time, the real skill is developing an intuitive feel for when the market is tradable versus when it is too random or illiquid, because the best scalpers make most of their money during brief windows of high clarity and sit out the rest, reinforcing the idea that mastery in scalping is not about trading more, but about trading selectively with extreme precision and consistency.